Hi, I'm Brianna Bowling. I'm the founder of Retreat and Learn. And today we're going to be discussing angel investing, which is a really important topic to me and one I'm really excited to share. Before we get started, though, I do want you to share this video. I want you to like our Facebook page. All of this is really important because I'm trying to share knowledge and I can't do it unless people know about it. So please help me along with that. So today, again, we're going to be talking about angel investing, and we have a great guest today. It's Greg Cangelosi, who is the chairman and co-founder of both Baltimore and Baltimore Angels. He is a passionate speaker and a consultant on entrepreneurship and marketing and innovation. He's the author of a book called The Business Podcaster Book, and I'll let him finish out the introduction. So with that said, welcome, Greg.
Thanks, Brianna. It's great to see you, and thanks for having me on your show. And let's spread some knowledge here. This is awesome. I love the video setup as well.
Yeah, it's fun, isn't it? I haven't seen you for a while. So Greg and I met actually at the Baltimore Angels, and so it's been a long time since we've actually seen each other in person. So it's good to see you too.
And you just popped up on one of our virtual meetings not too long ago. This guy was like, Brianna.
Yeah, there I am.
One of those COVID things where we were like, we have to, because we can't connect in person anymore with so many people, we just have to open this up, just kind of like what you're doing, and just spread the knowledge and spread the opportunities in our case. So thanks for joining, and thanks for having me. This is a good result.
It is. I know it's funny. It's kind of bringing together some new opportunities we wouldn't have had otherwise. So one of the things that I realized when I thought everybody knew what angel investing was, it was a term that I thought everybody understood. But as I've been walking around for the last, couple of weeks, kind of telling people, hey, don't forget, we're going to have this talk on angel investing. The response 9 times out of 10 has been, what is angel investing? Is that like with an angel? I mean, like, do people fly down? Like, what is it? Like, people don't know what angel investing is. So my first question is a super easy one for you. What is angel investing?
So, I mean, you're right. I mean, I'm not surprised you got a myriad of responses into what it is, but essentially, angel investing is early support for entrepreneurs and founders who are executing on a business idea that typically have proven it out to a certain stage, and that can be all the way up to a pre-revenue stage, but having some pilots in place that prove out the use fit and use case for the kind of problem solution scenario that most technology companies at least solve. These companies typically have, raised like friends and family money, been supported, if not self-funded the idea to this point. And then they go out for seed and angel funding. And angel funding could be, very much right on the end of the continuum of the friends and family / personal investment, all the way up through and including the Series A round of investing. So it depends on the appetite of the angel investor and the focus of any particular group or individual investor there is out there. And so it's really designed to, and I don't say design because it really should, you probably can ask 10 other people their definition and it might be a little bit different. I'm just trying to keep it as broad as possible. But it really is, that sort of that next level of cash to get the company from here with a very set, clear objective or set of objectives to get to a bigger round of financing if needed in that particular category, which quite often is, and that would be the Series A round. And angels invest in a number of different ways. There are individual investors who do deals on their own. Angel investors join an angel group like the Baltimore Angels. And then what they do, like in our case, we actually pool capital and we invest in through a Series LLC. So, which is great for not only the founder as well as the angel investor, because the angel investors, well, the founder, first of all, gets one line on their capitalization table instead of, let's say, 10 people putting in 100 grand, right? And you have 10 different people on your cap table. Through a Series LLC, our group will pull the money from the 10 investors, do one direct investment. And then on the investor side, typically startups in some cases, depending on the round, have minimums. They don't want to take anything less than a $25,000 or $50,000 check. So by using a Series LLC, we can appeal to the folks that may want to write a $10,000 check and participate in the deal. And then the third thing that's common for angel activity and angel investment in this kind of at this stage is to syndicate with other groups and other investors. So it's not uncommon that one of our VC fund partners or one of our angel group partners like K Street Capital down in DC will say, hey, we've got this deal. You take a look at it. and then we'll run it through our process. And often we wind up co-investing in some cases.
So what's it mean to syndicate? I mean,
syndicate would be like if you have let's say you're raising $500,000 for your angel round, or 750, and that's a pretty common area we see in terms of the size of the rounds, but it varies. I mean, they could be up to $1 million, $1.5 million as well. Typically, you'll have a lead, right? One person will lead it, a group will lead it, and say, okay, if it's 500, someone's taking the 250. And that's the lead investor, right? And the terms of these things we can get into later, but that leaves another $250,000 available for investment. And so the lead will then, and the founder of the company should also be out talking to as many investors as possible as well at this stage. And so you might get a group like ours will come in and take 100 of that 250, and then another group will take the other 150 to round out the $500,000. Round of investment. We call that a syndicate. So it's multiple groups working together to syndicate a deal to fulfill the fundraising goals for the company.
Okay. And then within that syndication, so like the two different groups make up the syndication. I don't know if it's a real word. I just made it up maybe. And then within those groups, there might be multiple investors.
Right. Correct.
So, okay. So it's good. It allows a lot of people to invest at a smaller level.
Yeah. So in our group, for example, using that same example, if you had 100, let's say we were going to take 100 of that remaining 250, we had 10 people that wrote $10,000 checks for that 100. We would pull that capital, and it would just say Baltimore Angels Series, the name of the company, and we would do it like that. And you're seeing I'm seeing, and a lot of folks in the space are seeing a lot more companies and groups invest through vehicles like Series LLCs. They're relatively new. They exist only in Delaware and Nevada right now. And basically what that allows you to do is, instead of having a single purpose vehicle for every single investment you do, which gets very pricey on administrative and legal and accounting costs per year, you have one bank account, one EIN, and then each separate investment is a series. And they're all indemnified from each other. They all have different cap tables. It's like doing a mini fund without having a fund.
So that's one of the big benefits. I mean, it was for me, I know, as a member of the Baltimore Angels, was that I could invest at a smaller level. I wasn't having to, shell out a larger amount of money. The other part was that you handled a lot of the paperwork. And that was a big deal to me because, certainly I didn't want to be having to have all these small deals with the different people. You took care of all of that paperwork. Yes. And that was immensely helpful, not only because it took less time for me, but also because I knew it was done correctly. It wasn't something I was going to mess up.
Thank you for your confidence in us. Yes. And it's something that, look, we're on our 11th year. So I would say the organic kind of growth of the Angels has been very interesting. As I was saying earlier, before we started our show here today, that Dave Troy, myself, a bunch of other Baltimore-based entrepreneurs just really wanted to make sure there was early stage capital available to founders. And it was really just based on that principle, having been the guy that ran around the city of Baltimore trying to sell 5% of his company for $25,000 so I can eat payroll, and everyone looking at me like, how do you justify that kind of valuation?
Right.
Versus talking to an entrepreneur who can hear my idea, see who I am, believe in me, and maybe, take a bet, right? Which is at the end of the day what we're doing here. All the way into, a very casual group, just meeting at the ETC conference rooms, just maybe someone bring a pizza, maybe someone bring some bottled water. We'd see 5 pitches, to forming it as a legal entity, doing that for probably 6-7 years, just again, the pooling of the capital, but not using a Series LLC. So again, everyone's kind of on their own. All we're doing is bringing deals to the table. And anyone who's a member of the group, who's been at least a legacy member, I always say, look, all we're trying to do is get better every month, right? Like, we don't know all the answers. Nobody really came from a background of angel investing. I was an entrepreneur who was running a company when I started doing this. And I remember somebody said, angel investing, huh? Yeah, you'll probably end up getting like a $250,000 education on angel investing through your investments. And I'm not going to lie, it's pretty accurate actually at this point after over a decade of this. Not to say there weren't some wins there too, but it is just sort of something that we've grown accustomed to. And then really when the whole thing changed, and I say grown accustomed to, kind of just getting together, seeing a bunch of pitches, not really having a lot of process, I would say on the professional level, but everyone's kind of learning at the same time, making some good bets, having some good wins, having a bunch of losses. And then around 2017, what I always did was as the managing member, and really not a full-time focus, but making sure it actually, was something that was taking place in the ecosystem here. I always hired a Venture for America fellow to be our administrator, or operations administrator, for the group. And when our last one was going to move to Switzerland, it opened up this sort of window for me to step back in as the operations person, the managing member, and do all the work again to keep it going. And that was through the end of 2017. And there I met a gentleman named Scott Garber,
Right.
who is today the GP of general partner of Early Light Ventures. And he wanted to do a fund, which he's done. But I said, why don't you come run the group for us, standardize our processes, really dig into this Series LLC vehicle, run the group, and then we'll raise a fund. Right. And that's what we did. But so 2018, 2019, we got much more serious. We have a 20-point diligence scorecard that Scott implemented. We're generalist investors, but it's really gotten more professional. And then at the end of the day, as a Series LLC, the Baltimore Angels has a management agreement to manage that. So we have money under management on behalf of folks like yourself and our other investors. And so we have 17 investments in our Series LLC, and we have an analyst, we have a director of operations, and we keep active stats on our portfolio. And I'm really happy to report that we just finished as of October 1st, our portfolio is running at a 43% IRR, internal rate of return, which is, we think, ecstatic for an angel group.
So Greg, I'm gonna so one of the things that I think a lot of people, because a lot of people are watching who maybe don't still understand fully what angel investing is. Yeah. So when you're doing it through a group, one thing that I want to make sure that you mentioned something pretty important there. So you're not only just handling the paperwork of things, but you're also helping to find and identify some of the potential startup companies that would actually be a good place to invest your funds. And one of the things that you provide is actually a sheet that says, hey, here are the pros of investing in this company and here are the cons. And I think that that's something that people don't quite understand. Like that's what would happen inside of an angel investment group.
Sure, yeah.
Which then brings me to my next question with that is that what actually, like when you're looking at what makes a good angel investor? Like somebody, it's not for everybody. I mean, this is not, I mean, certainly it is not the stock market. It is not the same as just, investing into your son's, company. It is different than that. So what makes a good angel investor and who should consider being an angel investor?
Well, it's an interesting question for sure. And again, when you think about the myriad of, definitions of what angel investing is, I think to your earlier point, it means a lot of different things to a lot of different people. But I would say the first thing is to not be afraid to take risk. And, it's not for the risk averse. And it's not for the faint of heart. There's a strategy around angel investing if you want to dig into it. And that, there's the idea, first of all, you have to be an accredited investor as well. And there's
what is an accredited investor? Tell me, because
so the SEC defines it as having, and I'm going to look at the actual definition for you, but essentially you have to have $1 million of assets and/or have a combined income of over 200,000. I believe it's $200,000 or $300,000 a year annually. Don't quote me.
So it's accredited. Does somebody accredit you, or do you just self-accredit?
You self-accredit. Yeah, you self-accredit.
I'm sorry, you broke up there. What was that?
You self-accredit. In other words, you shouldn't be.
So it's not an accrediting agency. You just take a look at this and you say, I verify that I am these things.
Yes, and you really should be accredited to get into angel investing and have some assets. And you should never, ever invest more than 10% of your total assets in angel. That's something that's also common as well. And there are some people that believe that's too high. Other people believe it's too low. It's more people thinking it's too high because it is really risky, and it's one of the highest risk asset classes of investing I think you can get, because really at the end of the day, and go back to your question, who makes a good angel investor? There's and I don't want to call it like, as it's dumb or smart, but there's that kind of definition of dumb money and smart money. Dumb money is, put money in and pray, right? Smart money comes in, puts money in, invests in obviously something ideally you understand, something that you could add value to, something has a founder or a CEO or a founding team that you have good chemistry and synergy with, that you feel like you can work with if you want to be on the active side. If you're an angel investor, a person who'd make a good angel investor in my mind is somebody who knows the risk involved, is willing to help the entrepreneur, whether it's just mentorship, advice. And again, you don't have to be a professional in that particular. You might have a founder who has an idea that you like the idea. I don't know anything about the industry, but if you have retail experience, if you've been in a big corporate position at a large corporation, you can add value to somebody who's doing a retail play or consumer products good. And where your level of expertise and your domain expertise, if you can make angel investments in things that you truly understand and add value, that's where I'd start thinking about the potential of making, a bet in a world. It's always hard to say someone should be a good angel investor without, I say, going to an angel meeting or participating in an angel group as a guest and understanding what's involved, how it works, the kinds of questions you should see. You mentioned the score sheet. What are the things? There's definitely an education process to this that I would suggest anybody do before they think about writing their first check. But that said, there's other people who just want, they want to be in on the game in some cases, and they coattail invest. And, it's like, well, those 4 people who I respect are putting money in that deal. I'm happy to write a check. But, running a group is it's challenging, but especially now where everything's predicated on in-person connectivity, shaking hands, seeing the chemistry of somebody. It's all happening now just the way you and I are doing it. But it's working. I mean, we're on our 2nd deal since May, and we'll probably be doing a 3rd by the end of the year. So it's wild how this happens. But going back to your question, angel, an angel investor, depending, I'd have a focus. I'd have my own kind of thesis about the things that, and let me tell you, after running the group for, almost a decade, I've seen it all. I've seen people come and go, and, our biggest challenge is always like, we never know who's coming back the next year, and their situations change. People come in, they just don't like the companies we present because we're presenting generalist, not themed investments, because it's all very much in what's on the flow right now. We went from, realizing that meeting once a quarter wasn't enough, because by the time we had a conversation with somebody and we get them in, their round would be closed. And it was just like, we also learned how to become very efficient in presenting these opportunities to angel investors. And I think once you have a knack for it, and you be able to spot the things that make a successful outcome, only then you should probably go out on your own, unless you get syndicated a deal through your own proprietary network, which happens commonly, to participate in. Right. That happens often outside of angel groups.
Right. No, absolutely. So we have a number of people watching right now. And while we are live, and thanks to everybody for watching. And not everybody feels comfortable asking a question, but if you do have any questions, while we have Greg here, certainly use him as a resource. There are no dumb questions. You can see I've asked some questions that probably Greg's sitting there going, whoa, of course she knows that. But certainly there are no dumb questions in this. We are all trying to learn together. So if you have any questions, feel free to post them in the comments, and I will go ahead and ask those to Greg while we are live. And if you don't, that's fine too. I'll keep asking questions. So let's move to the other side of
all learning, always.
Always, yeah. The other side of the coin is the investments. So what actually makes, when you're looking at potential companies to invest in and to bring to the Baltimore Angels group, what is it that you look for that would make them even be worthy of being shown to the Baltimore Investment Club?
Great question. They're really in no particular order, just kind of things that come to my mind. First of all, it starts with the people, right? It starts with the team. It starts with the team, right? And then we look at the idea, and we look at the product. We look at the product market fit. We look at problem, solution. We look at traction to date. Where we sit and where we invest, the product's got to be built. There's got to be at least a pilot, if not revenue already being generated. There needs to be a clear path where investment here, results in these outcomes here that are on a trajectory towards either, like I said, another round of financing or more revenue growth and more traction in the market. So we like to see, really it's a combination of obviously market fit, problem solution, but really it's even more the team, because I would tell you, and this is me personally, I would rather, invest in people versus the idea, because a really good entrepreneur, a really good founder is going to figure out how to make it work, whether that there's a pivot involved or whether maybe the first go-to-market strategy wasn't the best bet and there's another one. And those attributes are tenacity, resilience, hustle. And also we like to see founders that have skin in the game financially.
Right.
That really validates to me that you believe in what you're doing. Having seen over a decade plus of pitches on a monthly, now we're doing 4 meetings a month almost, because we have so much more time on our hands to not organize the meetings. I lost my train of thought, but yeah, I'm thinking about name tags and guest lists and catering and AV and 100-page PowerPoints. The people though, the hustle, and I was talking about that. What makes
Greg, one of the things that I think when you said that, it made me think of is that like when I owned my software engineering company, I used to always tell people if we interviewed people, it's much better to hire somebody who doesn't know much but has great work ethic than it is to hire somebody who knows something and their work ethic isn't quite there, and they don't have that hustle and heart that you're talking about. And so I think probably the same thing applies. Essentially, you're interviewing these companies to be your employees. It's the same idea, that's where you're going to put your money.
And so I picked up where I left off, was the, having skin in the game. And, I've seen over a decade that the founders who just are like putting their idea forth and maybe have a little traction, but have no skin in the game and have used all other people's monies, or at least have family money, or friends and family money, but it's better when they come to the table and they have, look, I'm in 50 to 100 grand on my own money on my idea. That shows total buy-in. It's not necessary in every case, because I realize that's not the case for everyone to be in the position to be able to do that. And there are diamonds, in the rough, and I always believe that. I don't take don't judge a book by its cover. And some of the most fascinating ideas I've seen. I'll tell you one recent one that I just won't mention names, but I remember this entrepreneur getting fashioned through the process. Horrible pitcher. I mean, just really bad presenter, but had a really good idea and was revenue positive. And Scott, our administrator at the time, said, they'll be exited in within 2 to 3 years, and at a huge multiple. And I remember the pitch, and like I said, less than exciting. Not even one hand went up for interest. Just a couple months ago, they sold to a huge company for a massive multiple. And again, so when you look at people, you got to look at more than just, it goes beyond just the initial presentation. If you dig deep and really see the way an entrepreneur is executing on their vision and the team they've built around them, and their ability to pivot, change course, and adapt to that change, really tells you a lot about the type of person you're kind of getting behind with an investment.
So it sounds like you need to have the people there. You need that hustle and heart. You need to have an idea. So one of the things too that you kind of went pretty quickly by, I want to make sure that people understand, this is not typically a company that somebody has an idea.
Right.
Say, hey, I had this great idea that I think we should do. They have to have some revenue. They have to have started something. This is kind of like, it's the second round of thought process here. It's past the concept stage.
There's like for lack of, I mean, this is not to insult my any of my creative friends. I think we're all creatives, by the way. Ideas are a commodity, and everybody has them, and everyone has the great. A lot of people have their great idea, and I think that the difference between having an idea and executing is like a world of difference, right? And so you got to be past the idea stage. You gotta have built something. You've got to have proven something out. You've got to have some kind of track record. You've got to have some kind of pilot, proof of concept, whatever you want to call it, under your belt, that demonstrates that you have at least what it takes to take the next step beyond your idea. We've never funded an idea, and we never will. It's just that's just like a fundamental sort of like, boom, you can execute on your idea. May not be perfectly, and it probably won't be, and nothing is, right? So, but if there's something there that's workable, it become an investable idea. But yeah, we do have a score sheet that Scott put into place, and we go over the top 3 reasons to invest, the top 3 reasons not to invest, the whole section on the team, the financials, the product, the solution. We net it all out. We score it. Anything over a 70 in our world is something that we call an investable idea.
But not a sure thing. And that's something that's really
thing. Yeah, absolutely.
Still a risk. They're a huge risk. So, Greg, we did actually get one question. I'm going to put it up on the screen, but I'm also going to read it to you because I'm sure it's probably tiny on your screen like it is on mine. But
which platform are you looking at too? I'm just curious.
I don't. Actually, this came through YouTube. So
yeah. Scott Hardigree, I know him. Hey, Scott.
He had a question. He wants to know how the leaders and operators, that would be somebody like you, how are you typically compensated?
Great question. Okay, so I would say we're really now just in the last couple of years figuring that out, because really the first 6, 7 years was really, like I said, it was just like, let's make sure this happens. So dues as a member started at $250 a year, went to $500, went to $750, went to $1,000, went to $1,500, or now at $1,800. And so the idea there was, at first, make sure there's food and drink, because our meetings start at 4:30 and go to like 7:30 or 8 o'clock at night, right? That was like the budget, right? Any ancillary costs, really, the whole thing is always run well under $100,000 budget a year, which means, as you can imagine, nobody's really making any money. This whole thing started off as a service to the community, to make sure that people who wanted to impact entrepreneurs could, and that founders had access to capital at the earliest, most vulnerable stages of their life cycle. So now, fast forward, so that's the way that and then we once we got to a scale enough where it was attractive to sponsors, we'd go out to banks, law firms, accounting firms, other larger ecosystem supporters like Green Spring Associates, who I'm proudly wearing their vest today, and they would support us as well and give us a little more. That's how we got to be able to hire a full-time Venture for America fellow, start using different softwares, get QuickBooks Online, pay our accountants, and do those types of things to get to where we are now. And this is really kind of a result of COVID, to be frank. And this is for you, Scott. I mean, what we're doing now, we've never, we're not money under management in the sense of like, we have a dedicated pool of capital that's your money, and we're making investment decisions for you. That's when you get into broker dealer compliance and SEC stuff. We present opportunities to investors, and the investors make their decisions on whether or not they're going to make that investment on their own. We will provide some supporting materials and whatnot. Now, up until COVID, our dues were $1,800, right? So you can model that out over 50 members. What we realized was, and then some sponsors, right? So there you get it to sub 100. You pay. Right. Zach Paskoff is our director of operations. The majority of that, we have an analyst who's got a master's in finance. They both get paid. It's not a big budget. It's not a big money maker. But when COVID hit, we realized, and we kind of did a 2-month assessment on, what was going on in the market, and we realized, well, it's still game on, because there's a lot of things that are changing in a different way. So we did what you'd expect. We pivoted to Zoom, and we started doing virtual meetings. And like I said, we're completing our second investment of the year since May. We took two months off, and we decided, you know what? After doing some research on the Series LLC vehicle that we use, and you're seeing more and more angel groups do this, we take a placement fee on the investment anyway of 4%. So that's to cover our legal costs and our admin costs. But we've never taken a carried interest on any opportunity that we've brought forth, meaning that we're participating in the upside. So if you put money in, for those who don't know what that is, we just present the opportunities, the investments go in. If they do well, their exits, they come back. We're doing a lot of work to get people into those deals without any of that upside, right? And so now we're moving towards what's called a subscription-based private placement, which means as long as you're accredited and you're in our investor network, we're taking down the paywall of membership and calling it a syndicate, right? So it's a syndicate of a bunch of investors. So to answer the question, most angel groups are compensated by sponsorship and annual dues. There are groups like the New York Angels, who I think their annual dues are $500 to $7,500 a year, and then they have a per deal fee. So those things start to stack up if you're an active group. Others like ours, we're aggregating sub $2,000 annual membership dues and gathering another $30,000 to $40,000 in sponsorship to make up a $75,000 to $100,000 budget. And like I said, I'm just an orchestrator and a conductor with all this. It's not like my primary source of income. However, I did want to make sure, and I've always wanted to make sure with most of the things that I do, that they're sustainable and they can carry on. And with the great team we have, Zach and Connor, and the partners that we have, we feel like now's the time to say, hey, look, we're doing a professional job. We're at a 43% IRR in our portfolio. We're doing good work. Let's get a little skin in the game on this. And so we've opened it up to our network now. And so to answer the question, again, another alternative is to not only have membership fees and sponsorship fees, but deal fees and a little upside on the carried interest. That means if I put $10,000 in, that investment goes, let's just say it comes back as $50,000. The money comes back, you get your $10,000 back, and we get 20% of the 40. We're at 15% of the 40,000, or a percentage of the up.
So you win when we win, basically.
Correct. Yeah, we win when everyone wins. Yeah, and that's the way I think it should be in the future, because that way we don't have a paywall to investors. We have a lot of people who've come through our pipeline as members, as guests, et cetera. And I realized even with the meetings too, it's like if you pay $1,800 and you don't come to at the time 10 meetings we were doing a year, you just kind of feel like it's not worth it, right?
Right.
But now if we all just click on a link in our browsers and we're presented with the opportunities, and we can still talk to the founders, and we could still get all the benefit of the research and the scoring and the diligence and the syndication power. It's even more efficient. We could focus more now on the companies, to be honest with you. And
it's way more efficient. It becomes less of a social gathering. It becomes more of a business function. And also it opens up the geographies of it. Really, somebody in Arizona can participate, just the same. So
we just had a member rejoin who's down in Southern Virginia because we started doing meetings. It's like, oh, I can come now. I'm like,
right. Exactly. So, all right, Greg, we are probably about out of time now, but I think we went through it really fast. There was a lot to discuss, which was great. But if anybody has any other questions, I'm going to put, I have another meeting right after this, so I'm not gonna do it right away, but I will be posting in the comments. And also I'll be writing a blog about this, and I'll be putting the information about how to contact Greg and how to contact the Baltimore Angels in both the blog and also in the comments. So if you have any other questions for Greg, his contact information will be there and you can contact him directly.
Thank you so much, Brianna. This has been great.
Yeah. So thanks so much. Thanks everybody for joining in. Thanks for the questions. Thanks for the comments. And definitely thanks for joining me today, Greg. Thanks.
Thank you. Take care. Have a good one.